It is time to talk about money. That's what we're here for. We're Al, we're Chris, and we're Mike, and we're here to talk about money. So I want to start with a question. I want to ask you this. Suppose you received an email from a person you didn't know, had no idea who they were, and that email said, buy stock A, it's going to go up. You don't pay much attention. You don't know the person. You don't know anything. You skip on to other emails. You put it out of your mind. But then at the end of the month, at the beginning of the next month, you get another email from that same person that says, sell stock B. And did you notice? Stock A went up. And you check, and sure enough, A went up. So you still disregard it. You don't know what's going on. So then, the beginning of the next month, you get another email from this person, and it says, buy stock C, it's going to go up. And you pay a little more attention. You look, B's gone down, A went up. So you begin to log it in your brain and think about it a little bit. But at the beginning of the fourth month, you get another email that says, buy stock D, it's going to go up. And you look, A went up, B went down, C went up. And so now you begin to follow D a little bit. And sure enough, it goes up. And now, on the fifth month, you get another email that says, buy stock E, it's going to go up. And now you begin to pay attention. And sure enough, it goes up. And then, after 6 months, you get another email that says, buy stock F, it's going to go up. And sure enough, you're now tracking and following this. Then in the seventh month, you get one, sell stock G, it's going to go down. I think that's different, but let's see what happens. And sure enough, 7 months, 7 correct predictions. Month 8 comes, another correct prediction. Month 9 comes, again, another correction. Month 10, another correction. Month 11, the email comes in, and now you're really alert, because you get the email and it says, will you invest $1 million with me? Would you do it if that was happening to you? 10 for 10. Never a miss. Not one single miss. When they said it was going to go up, it went up. When they said the stock was going to go down, it went down. Would you give them $1 million? 90% of the people sure would. I mean, this person has been right on.
It's like Richard Thaler's thing, the behavioral economist. You know, he says, what does he call it? The shooter's fallacy, right? The shooter makes one shot, makes two, makes three, and people start betting he's going to make the fourth, he's going to make the fifth, and sooner or later he's going to lose, right?
But there's a twist in the story.
But there's a twist in this story. Because what you don't know is that emailer started by sending out 10,240 emails. To 5,120 people, he said stock A was going to go up. To 5,120 people, he said the stock is going to go down. Now, the 5,120 people who he said the stock was going to go down never heard from the emailer again. But the 5,120 who he predicted correctly, the emailer said it was going to go up, and it did. He sent 2,560 saying stock B was going to go down. And 2,560, he said the stock was going to go up. Now, the 2,560, where the emailer said the stock was going to go up and it actually went down, they never heard from him again. But the 2,560, where he had predicted up and down correctly, to them, he sent 1,280 saying the stock was going to go up, and 1,280, the stock's going to go down. And for the people where the emailer was wrong, they never heard from him again. 640 then got an email that said the stock's going to go up, and 640 said it's going to go down. And for the 640 where it was wrong, they never heard from him again. And you work down the numbers, at the end of the time, there were 10 people where the emailer had been correct 10 times. 10 people left, but 9 out of those 10 will probably open an account for $1 million. You know, it's a story that's been around a long time. It's called the Baltimore Stockbroker Story. Nobody knows why it's called the Baltimore Stockbroker Story. There was not a stockbroker in Baltimore. There's no relationship to what Baltimore was. It's been around a long time. Since I was a rookie broker, when I first heard this story, it's been around, it's been a joke. So now you know the story as well. But the point of the story, the reason I bring this story up is what's going on in our industry is a lot of similar things. You don't see everything that's going on. And so you're going to hear in this program today, you're going to hear from Al, you're going to hear from Chris, and some from me as well. You're going to hear about some of the things that go on that no one else hears about or knows about. You're going to see things which are just like the Baltimore stockbroker, those things that look right 10 times out of 10, which are actually dead wrong. So let's start by talking about some of the history of mutual funds. And I'm going to turn it over to Al.
The history of mutual funds. Well, the first mutual funds actually started way back when in the 1700s. They started in Britain and they started in Amsterdam.
The 1700s.
They started the 1700s.
Wow.
They were trust funds that people collected money, and they were what's called a closed-ended fund. And that means is that you had to sell your shares back to somebody if you bought into that fund, right? Unlike the first mutual funds that were actually, as we know them today, were actually started in 1924 by the guy by the name of Edward Leffler. He started the Massachusetts Investment Trust. And those funds, the difference is that those shares were redeemable, right? As opposed to you didn't have to go find a buyer for those shares. Like the problem with the closed-ended funds, Mike, as we talked about, is that what these guys would do is go buy a stock at $3 and put it in the fund at $5. It works out great till you want your money back, right? But with a redeemable mutual fund, what happens is that they're continuously creating new shares, so you can always redeem your shares at whatever the cost the fund is at.
And it's similar. It's the same thing as we have the concept today.
Yes, yeah, very similar. So those were the first ones that were started, and they were actually good funds. They were value-based funds. They bought mostly dividend stocks, and they were kind of like what we do. They were concentrated portfolios. They worked really well. There was of course, there was always somebody coming along trying to manipulate and things going on to try to create more revenues for themselves and stock. We'll get into that stuff later on, which is still going on. But a lot of these older funds were really well built. They were value funds. And what they did is when the fund started to get too big, they closed the fund because they said, wait, I can manage this much amount of money, but I can't do the same things as I can with with too much money. So they closed the fund and would have to go start something else.
Mm-hmm.
So that's kind of where we are today.
And they got going in the 20s.
They got going in the 20s.
Things slowed down in the 1930s, of course.
Obviously, yeah.
But by the 1950s, mutual funds were roaring again.
They were roaring again, yep.
And this time it reached a much wider audience.
It did, but it wasn't really until the 70s, right, when things started to take off. People started moving away from pension plans, and ERISA came along in 1974, right? And then in 1978, there was an act that created something called the 401k. And then mutual funds really took off in the 80s. And these companies were trying to figure out these companies spend a tremendous amount of money marketing, and they try to figure out how to market these things to get them into portfolios, into 401ks and all these things. And they decided back in the day, it was Fidelity back in the 60s, and the first famous fund manager was a guy by the name of Gerald Sy. He was the one. Gerald Sy had a growth fund that took off like a rocket.
The Manhattan Fund.
Was that the Manhattan Fund?
That was the Manhattan Fund.
Okay.
And the Manhattan Fund had tremendous returns because Gerald Sy was buying 144 stock. Now, when somebody is a principal of a company, they get stock, but it's red lettered. It has the symbol. Back in the certificate days, they stamped it with a red symbol, a red 144 on the back of the stock certificate.
Right.
And they were locked up. They couldn't trade those for a certain amount of time, 6 months or a year.
They were restricted stock, weren't they?
Restricted.
Yeah, restricted stock, yeah.
And if you do want to trade a restricted stock, you have to get an attorney's opinion that it's real. You have to go through hoops and...
Yep.
So Gerald Sy would pay and buy lettered stock, it's restricted stock, and not on the market. He would just buy the certificates, pay a 25% discount, bring it into the Manhattan Fund, and bring it in as full price. And everything worked fine until people wanted their money out.
Right, and that's exactly what happened in the 20s, right, with the closed-end mutual funds. The same thing happened. They bought, in the 20s, they were buying railroad stocks, right?
Yeah.
So
So don't go away. We've got more. We've just got started on this. You want to hear about some of the other abuses. Manhattan Fund was famous. It began famous. But there's a lot of other abuses, and some still going on today.
About Money continues. Remember the website, adamsfinancialconcepts.com.
The next guy that came after Gerald Sy that was a rock star in the mutual fund industry was a guy by the name of Peter Lynch, who averaged 29.2% a year for 13 years with the Magellan Fund Fidelity. But what the industry quickly realized, guys, is that if they started promoting these guys like Gerald Sy and Peter Lynch, and they put Peter Lynch is on the cover of all the magazines in the 80s, if you remember, Mike, and they realized that, oh, wait, these guys are going to be snatched up and go start their own fund. So the T. Rowe Price and all of the companies started saying, we're not going to do that anymore. And they started promoting the companies. It became marketing for the companies.
Oh, yeah.
Right?
I remember the 1980s, and American funds had a star, and CGM funds had a star. I mean, they one after another of the companies. Rowe Price was a star. John Templeton was a star. Anyway. And
so, but these companies realized promoting the stars was not the way to go, right? So they started promoting the company, right? And they spent as I said, they spent a tremendous amount of money on marketing. Of the books that I read, the one that I liked the best was Louis Lowenstein's The Investor's Dilemma. It's a fantastic book. It's full of detailed information about the industry. And he talks about that T. Rowe Price spending so much on marketing. If they didn't spend the money on marketing, the SEC would come in and force them to have to lower the cost of because they're making so much money. He said it's a money-making machine. They're basically, he broke it down. If you read his book, I don't want to break it down on the radio here, but he broke it down, Mike. He said for every dollar they had, they were making 80 cents on the dollar.
Oh, yeah.
It's a cash cow. He said, forget about robbing the banks. He said, go rob the mutual fund companies.
It's what Willie Sutton, they asked him why he robbed banks, and he said, because that's where the money is.
Yeah. No, that's what he says in the book. He says about Willie Sutton. He said Willie Sutton was wrong. He should have robbed a mutual fund company. Because they do things that people don't really realize what they're doing. Everybody's looking at the load of a fund. And they see let's just talk about load funds, right? Loaded funds. There are still loaded funds out there. But beyond the load of a fund, there are a million different costs that get broken down in the fund that people never see, that are buried in 50 pages of minutia in a prospectus. And what did we figure out that he says in his fund that the average cost of a mutual fund is actually 3.17%.
That's today.
Wow.
Yeah, that's today. Yeah.
That's not then.
No, that's today's today. Dollars. Yes. And what happens is they have trading costs, right? They have, what's the other cost they have in it?
They have soft dollar.
Soft dollar cost.
That's a crazy one.
So what? Go ahead.
If you go down the list of fees, mutual funds carry a significant amount of cash for redemptions. So it's a cash carry cost as well.
Right. And so here's something funny, Mike. You're going to love this one. So when the pressure became on the load funds, they went to these no-load funds, right? What did the companies do?
Go ahead.
The companies, what they did is they said, okay, we'll get rid of the loads. And they come up with something called, in 1985, they'd come up with different class of shares, A, B, and C shares, right?
Right.
And then they had Rule 18F3 to the Investment Advisement Act that let them have 12B1 fees.
Correct.
And that's where your 12B1 fees came from. And so you got people out there choosing what A, B, and C shares, some with no load up front, but have a contingent deferred sales charge on the back end if they sell out of this thing, if they don't hold it long enough. So they figured out a way how they could have their cake and eat it too.
Yep.
I don't think people really realize all the costs that are associated with the 401, or not even 401ks, but just the mutual funds.
So Chris, tell us about that.
I mean, there's over 17 different fees that are charged, and most people aren't aware of any of them.
And most of them are hidden anyway.
Oh, exactly. And I did a little bit of reading, and there's a number of articles out there. Forbes has put out some. Jack Vogel of Vanguard was a big proponent of this as well. But a lot of people aren't aware of what they're paying. They think that they're paying just in the expense ratio, which is basically like the list price for the fund. But when you dig deeper, there's so much more to it. And one of the ones that really gets me going and really gets me worked up was what they call the transaction costs. Now, transaction costs are not the only fee that you're paying, right? Transaction costs are actually broken down into brokerage commissions, right? They're broken down into market impact costs. And get this, a market impact cost is the cost of moving a market as mutual funds trade massive amounts and essentially moving positions in the market, right? Because they own about 60% of the stocks out there. And then another one is like a spread cost. So they're literally charging you a fee between the difference between the bid and the ask price. I mean, it's just ironic how creative they get with some of these fees.
Oh, yeah.
So my favorite of all of them, though, if I'm going to go down the list, is definitely the soft dollar cost. And, for those that do not know, it's essentially a quid pro quo arrangement where the mutual fund managers choose to pay an inflated trading cost to an outside firm, right? This is something that Robinhood's in hot water right now for. And essentially, by executing their trades, they will then rebate those additional trading costs back to the manager. So, another way of saying this is like the frequent flyer miles of Wall Street, right? You get rewards for using a particular vendor. And so the fund managers can then use these funds to pay for certain expenses such as research and reports, which you would think that they were already paying for themselves, but no, that's passed on to you. And so at the end of the day, you're paying for research reports, you're paying for commissions, you're paying for these transaction costs that, on average, they're about 1.44%. And then you're paying a cost for essentially moving the market when they're just doing their job.
Yeah,
I mean,
so I was just going to add that Edward Jones, right? They had 7 fund families with their preferred fund families, right?
Yeah.
So in 2004, they paid $75 million and plus another $125 million in cash and credits to clients because they were putting them in just using these preferred funds, right? Did that stop them? No, because in 2005 they made $172 million in revenue sharing.
Yeah.
Yeah.
And
a year later.
And people only think they're paying 1% because that's what the expense ratio says, right? They don't look into these 50-page prospectuses, nor should you, right? There's no point. But if you do, you'll find these costs. I think my favorite, though, I know I've had a couple of favorites, but the account fee. Have you heard of the account fee? You know what that is?
Enlighten me.
So essentially, it's a maintenance fee for having the account with them, right? You get charged a fee for just simply owning it. So I pose this question, if you had your money in a bank, would you pay the bank a fee to hold that money for you? Probably not, right? Because essentially if that were to happen, there would be a run on the bank. No one's going to pay interest for the bank to hold it. And so why are we doing that with our mutual funds?
Yeah. So the SEC actually challenged this, right? They actually but the industry got together. I forget the year, but soft dollar section was added. 28E was added to the investment advisor company. It was a safe harbor was added. Funds continue to cover overhead, rent, memberships to golf courses, even backup generators. It's a true story. They were buying
backup generator.
They were buying golf club memberships in some company in New York. I think remember which one he said, and they bought a backup generator.
But remember what happened in this whole thing with the soft dollar cost. People raise questions. You're paying people. You're bribing advisors. You're bribing companies by paying them dollars. So they came up with this idea. We won't pay them dollars. We'll give them golf club memberships.
Yeah.
We'll give them research.
Right.
We'll give them tickets to the Mariners.
Mm-hmm.
Well, probably not the Mariners, but to the Yankees or whoever it might be. And we're not giving them any money.
It's funny, being younger in the industry, right? A lot of this is new to me. I always wonder why these wholesalers that come into our office have so much money. Like, why are they taking me out to eat
$100 bottle of wine and a $50
bottle
steak?
of wine, a $500 shot of some whiskey? I mean, it's just like, where are they getting this? I don't have that kind of money. My clients don't pay me enough.
You heard the lady when she came in. Oh, it's not about money. Don't worry about it. Just get whatever you want.
Yeah. Well, it's 17 different fees. I mean, it makes sense why they have all this money to spend.
It's like the old book in the 30s that I have. Where are the customers' yachts? The guy walks down to Wall Street trying to get his new trying to get this guy to invest with them, and he walks down to the Battery Park and says, "Those are all the broker's yachts." And the customer says, "Well, where are the customers' yachts?"
No,
they're working.
So this is what's gone on with fees, and most people are not aware of what's going on.
They have no clue.
No clue.
They have absolutely no clue.
Absolutely no clue.
They say, why would I hire you when I'm only paying 1% for this mutual fund? And then on top of that, keep in mind most people are paying a broker and advisory fee as well, right? So if the average fund costs about 3.1%, and then your average advisor is charging right about 1%, I mean, people are paying about 4% in fees when it's all said and done, between 4 and 5%. And no wonder people are working longer into their lives and they don't have money saved up for retirement. It's all being eroded by, these fees.
But Wall Street's happy.
Oh, yeah.
And because Wall Street makes so much money, it's in the billions of dollars.
Mm-hmm.
And so even when The Obama administration, during the Obama administration, they came up with the Department of Labor putting on and wanted to disclose a lot of fees. You can charge it as long as you disclose it. Even when that happened, and some of the fees did go away for a while, the banking industry, the brokerage industry, the insurance industries spent tons of money arguing against it. The Dodd-Frank bill, tons of money funneled to senators and congressmen to vote against some of the provisions and to negotiate. And I can remember, I don't know why I was was selected for the luncheon. I was one of the few RIAs at a luncheon where the language for the Department of Labor fiduciary rule came up.
Yep.
And that was written by Brian Graff and his partner. Essentially, it was written by two lobbyists. And the people in the room were Merrill Lynch, UBS, Credit Suisse, all the big companies. Bank of America was there. The banks were there, the big brokerage firms. And maybe I was the token RIA. I don't know. But they're spending a ton of money to keep those fees.
All right, we are back. So, before the break, we were talking a little bit about, the different fees associated with the mutual funds, and for a lot of people, especially when I bring this up, a lot of my clients and some of my friends and family, they say, Chris, what is the difference between, 1% and 2%? Who really cares, right? That's not that big a deal, right? Obviously in our world, this is a huge deal, but people don't really understand. So what I want to do is share a little bit of a story to kind of, dissect this a little bit more and why, 1%, 2% means a big deal over a number of years. So take this. There's three friends. There's John, there's Alex, and there's Sophie. And at the age 35, they all have $100,000 to invest. Each selects a different mutual fund, and they are all three lucky enough to have, equal performance in the market, which would be 7%. So fast forward 30 years, they are all now 65, and they get together to compare account balances. Let's see how we did after the last 30 years. Well, once they start comparing the numbers, they realize that the fee that they had been paying is a lot different. They realized that the fees that they were paying were 1%, 2%, and 3% respectively. So the impact of this is actually pretty staggering, right? So John, he had $100,000 to invest when he was 30 years old. This grew at 7%, but he was paying 3% in annual fees to his mutual fund. And so can you imagine at the end of the 30-year period, he was at $324,000 and a little bit of change. So keep that in mind, $324,000.
That sounds like a triple.
Yeah.
That sounds like a huge number, right?
Well, over 30 years, right?
Yeah.
So that's a good thing, right? 7%, 3% fee, it tripled his money. It's good. But then we got to look at Alex. Alex had the exact same amount. He had $100,000. It was growing at 7%, but he only paid 2% in annual fees. Can you guess how much that he had when he was 65? $432,000, almost $100,000 more. Now, this is where it really gets interesting. The last person, Sophie, again, started $100,000, 7%, but she only paid 1% in annual fees. After 30 years, she had $574,000. She almost had double the amount of John. And they were only paying a 2% difference in their fee. And so for me, this is fascinating because the same amount, the same return, and Sophie had almost twice as much. So at the end of the day, it kind of poses like, which horse do you bet on? Do you bet on the one with the 100-pound jockey or the one with the 300-pound jockey? Just 1%. I mean, it's the difference between, being worried at retirement, having a lot of anxiety, clenching, worrying about bills, and then being able to be peaceful and enjoy a nice quality of life and not worrying about bills. And so, 1-2%, it has a huge impact on people's portfolios.
Oh yeah, just think about it. If somebody had $100,000 to invest, would you really make the investment if you knew that you were taking 100% of the risk? But the mutual fund company, if the account goes up, they're going to keep 60% of the return. Mm-hmm. You get 40%, but you get 100% of the risk if it goes down. Mm-hmm. That's what we're talking about.
That's like T. Rowe Price, right? From 2003 to 2005, the stock doubled. The aggregate growth in their funds, their largest funds, right, was 0.54% against the S&P 500's 9.07.
Yeah. I mean, this is what's going on.
So you would have been better off investing in their stock than... Why is that, though? Let's break the industry down, because you only break the industry down, right? Because these companies are not focused on return, right? They're focused on growth, of getting assets under management. That's the focus. And they get so big. Why don't they close funds when they get so big? Like the Growth Fund of America back in 2005 was $190 billion. Why didn't they close the fund? And even when they do close funds, Mike, what they do is if they do close a fund, they end up opening, because they like the attraction to that fund because money's flowing into that fund. So they open up a sister fund, which doesn't perform as well and takes just as much money.
So, 1986 is when I licensed. And I can remember having a wholesaler come in. And when a broker would leave one firm and go to another firm, the client's books would be passed out to the remaining brokers at the firm, and you'd call the people to try to get them to stay and not to move their account. And as a new rookie broker, I got one account, which was very small. It had been an account that had started with $10,000, and it had fallen off to $8,000. So a wholesaler comes in to the office, and I'm in the business maybe 3 or 4 months, and talks about this mutual fund, the same one that this inherited client had. And they've got a track record that it shows that it's going up 20% a year for the last 5 years. And I heard the presentation, and as other people were asking questions, I go out and I think, I must make a mistake. This new client I have can't have this mutual fund because she invested $10,000 a couple of years ago, and it's only worth $8,000. So I came back and I said, oh yeah, it is the same mutual fund. So I asked the wholesaler, I said, how can this be? And they said, well, there was a merger of mutual funds. So there was a small fund that was growing at 20% a year. The big fund had kind of captated it. It was down 20% in a couple of years. And they merged the small fund into the big fund, and they took the track record of the small fund and kept the big fund's name. So, I mean, that stuff goes on all the time.
Yeah, it's like Louis Lowenstein, in the book I read, The Investor's Dilemma, had on one page. He recalls a conversation with the head of a fund family who said, and I quote, "I try not to achieve good results. I just try not to look bad."
Oh.
Here's a head of a fund family saying that's what his approach is, right? That's like when you play, you guys played sports, when you play not to lose, right?
Yeah.
Like Atlanta Falcons in 2015 against the Patriots. That worked out really well, didn't it?
No, there's the old saying that Wall Street is driven by fear and greed. Mm-hmm. And I believe there's a third one, that it's the fear of looking stupid.
Yep, I agree.
Mm-hmm. And what you see a lot of times is at the end of a quarter when the mutual funds have to report their holdings, they'll go through their holdings and realize we shouldn't have had this stock. So they sell that stock at the end of the quarter so it looks good. But then they might buy the stock back within a couple of days when the quarter begins.
Yeah, and I read a lot about that, what they do, right? And these large funds, right? So they'll go and they'll buy, okay, we have 150 or 200 positions in this fund, right? We got Microsoft, Google, Exxon. They'll have 20 or 30 of the biggest companies out there, right? Hold that in the fund, right? And then what they'll do with the other, let's say there's 100 positions, to make it math simple, they'll have the 20 top positions, right? But the other 80 positions, they're trading like crazy. So the trading fees and transaction fees, the turnover in those funds, right? Put this in perspective. The turnover in those funds can be 121%. They have no conviction to those 80 other stocks. And the companies don't care as long as they're taking in money and they got the big boys in the portfolio. But that transaction leads to very poor results.
Oh, yeah. And I can tell you, our accounts have been down. And I get this idea once in a while, I should start trading.
It's that little devil on the shoulder.
You begin to feel, because you know that the way you make money in the market over the long term, it's the sitting that counts. Jesse Livermore said that. It's the sitting that counts. Jesse Livermore in the 20s was worth $100 million. But he couldn't sit. He continued to trade and eventually ended up committing suicide because he lost all of his money.
You remember Bob Rodriguez ran the FPA fund? And he was from Los Angeles, so he averaged 14.2% a year from 1984 to 2009, until he retired, right? He explained to the Wharton School because his funds were down, same thing like us, right? So he went to the Wharton School, and he's talking to the professors and the students. And he says, I don't care about market risk. I only care about business risk because the fund has a tight investment concentration. He defines his investment time frame. He's willing to accept the greater portfolio risk for the long-term gains, where most mutual funds, they don't care. They want that Morningstar 4- and 5-star ratings. They want that short-term gain so they can just attract more money into the funds and watch people trade into the 4-star funds and another 4-star funds, and this fund's a 5-star fund. Well, we'll just get rid of that one and go to another one. And that's what people do.
So what does it take for one of these companies to become a 4- or 5-star fund on Morningstar?
Have a couple good years. That's it.
That's
they go
it?
by past performance. Yeah, they did a rating. He talked to the guy. What was the guy's name that ran Morningstar? I don't know if it's Bob. I can't think of his last name. But anyways, Lowenstein talked to him and said, "Hey, what about these ratings of 4 and 5?" So they had to go back and rework them. I don't know how they work them now, but back in the 90s when all the tech stocks were taken off, right? All those funds were 5-star funds. 2 years later in 2002, they were all 1 and 2-star funds.
Awfully fluid.
Yeah.
Oh, yeah. I mean, the temptation is always there to trade. You have to sit down, go get a cup of coffee, and come back and say, is that really what I want to do?
It's not like he says, like Rodriguez says, fantastic money manager says sometimes doing nothing is the way to go.
It is. It's proven to be the way to go.
Yes.
Whether you talk to Lynch or Buffett or Templeton or Price, all the great investors, they always made their money sitting, not trading.
Mm-hmm.
That's one of the anomalies where you think about somebody that's doing really well and the computers that are trading. You don't find computer trading and these computer trading programs, many of them that can consistently perform over the long term.
Mm-hmm.
No, most of them are just taking advantage of small little spreads between different exchanges. I mean, they're not buy and hold for the most part.
I want to come back to one thing after we come to the commercial break, and that is mutual fund managers are graded on their performance. And there's something to say about that because we'll talk about the average life of a mutual fund manager when we come back after break. So we are coming to commercial break. You're hearing about mutual funds? Started this talking about the Baltimore stockbroker. I hope you're understanding some of the hidden, dirty little secrets in my industry, about our industry, about the things that go and you don't understand what's really happening. So don't go away. We'll be right back after this. So Gary Palmer once said, the harder I practice, the luckier I get. That's not true of mutual fund managers. The career path of mutual fund managers, the role of merit, was a study done by Gary Porter and Jack Titus. They published that in the Financial Analyst Journal back in 2014, and I realize that's pretty old. But they looked at 2,846 mutual funds between 1996 and 2008, 1,825 mutual fund managers. And what they found is looking at the mutual fund managers by year. In the first year after a mutual fund manager was appointed and became head of a fund, 19% of them were gone, had been fired. By year 2, another 19% were gone. That means for mutual funds, 38% of the managers are gone within 2 years. Another 17% gone in the third year, and in the fourth year, another 12%. So that means in the first 4 years of a mutual fund life, 2/3 of the managers are gone. 2/3. Because of performance. So, I mean, when you look at it, if you look at where they are, there's about 5% of mutual fund managers that survive 10 years. 95% are gone before they get to the 10-year mark. So what you're looking at is a lot of turnover, a lot of change, a lot of strategy change, along with all the fees that go along.
Mm-hmm. Mm-hmm. And Mike, you said that mutual fund managers are graded on performance. Well, what is performance? Well, that is an average return. And so what I think of is actually the book, and it's done by Daryl Huff, and it's titled How to Lie with Statistics. And this is something that Jack Bogle also talks about, and he warns a lot of investors that there's a very masterful slide of a pencil. The average return is often an illusion. So the easy way that I like to say it is average returns are kind of like your profile picture on a dating app. They paint a much better portrait than the reality, right? You guys like that? So let me break it down so I can actually show you how this works, and it's the illusion. So it's best described with a hypothetical market that's up and down, kind of like a roller coaster. One day you're up 50%, then the next you're down 50%, then you're back up 50%, and then you're down 50%, right? So you would expect this to produce an average return about 0%, right? Because you're up, down, right? And like me, I would expect to be a 0% return, but really what happens is we would both be wrong. You would actually be down 43.75%. Well, how does that work? Well, okay, let's take an actual dollar amount, right? Let's say $100,000. And at the end of this period, 4-year period where this happened, you would actually have $750,000, right? So how does this work? Well, if you do the math, if you have $100,000 and it goes down 50%, you would have $50K, right? And then let's say you get a 50% return. So then your new balance of that $50,000 would be $75,000, right? Are you guys following me?
Mm-hmm.
So then you would lose another 50,000 or 50% of the 75,000. So you're now at $37,500, right? And so then that 37,500 gains 50%, so you would get to 56,250, right? So at the end of the day, you're going to be down $43,000 because of this, even though the average, performance says, oh, you should be flat, you should be at zero. But in reality, when you weigh it with the dollars, it's a much different portrait.
Oh yeah, I once heard somebody report that they were doing separately managed accounts, and they said during the Great Recession we were down almost 50%. Mm-hmm. But since then, we're up 64. So they made it sound as if people were making money, but it's the same thing. Mm-mm. People went from 100,000 to 50,000, and then 60% of 50,000 is 30,000. People were still down 20%.
And this is just another tool. This is just another tool that they can lie.
And they make it sound as if you're doing really well.
Mm-hmm. So on another note, we talked about mutual funds and what's going on in the industry is, we talked about no-load funds. We talked about, but when people go to buy mutual funds, Mike, is, these supermarkets and mutual funds like Schwab and Fidelity and everything like that. And what's going on there is that they see these funds, there's no commission, there's nothing on them, but what happens is they're doing what's called revenue sharing with the brokers that are selling these funds. And so there actually are fees paid in these funds that just, again, is something that's hidden that nobody can see.
So the whole point is coming back to the Baltimore stockbroker. Mm-hmm. Remember, you get the email that says buy stock A, it's going to be up. Stock B is going to be down. What you don't see is the emailer started with 10,000 emails they were sending out. And I shouldn't keep saying he because it could be a she, or a they. But I mean, it's the things you don't see that make the huge difference. We've been talking about the fees. We've been talking about the managers. We've been talking about what happens and what has been happening. And the things we're talking about are all legal. It doesn't even count the things like Jared Sy was doing back with the Manhattan Fund. And we see some of that going on. We saw at the time of the dot-com bust that the SEC refused to go after the mutual funds. It was Elliot Spitzer, who was the Attorney General of New York, mm-hmm. that really went after the mutual funds. We saw the brokerage firms, the research firms that were bringing all these companies public and sticking them in their mutual funds and putting it up. I think it was E-Trade that had the ad of the manager of the brokerage firm saying to the advisors, don't talk about the fundamentals. Let's put some lipstick on this pig and deliver it. They were talking about stocks, but a lot of that is about mutual funds. And if there's anything you should take away from this program, there's a lot of things that are going on that the individual investor doesn't see.
Mm-hmm. And it's an industry-wide thing. It doesn't matter. I mean, there are some good, don't get me wrong, there are some good companies out there, but it's an industry-wide thing where these companies, all they focus on is growing AUM and not focused on actual returns, actual real returns, not what Chris said, not the what they call the time-weighted returns, which is what the mutual funds show you. They don't show you the dollar. You can't eat the time-weighted returns, Howard Marks says, right? You can only eat the real dollar return. So that's what you really want.
You do. Statistically, you want it to be correct. You want to know what the fees are, and you want to know what the long-term performance is and what the manager is doing.
Mm-hmm. And if you're invested in mutual funds right now, just take an hour and read through the prospectus, read the actual cost that you're paying, because if you think you're just paying 1% for that fund that your broker put you in, I mean, you're probably going to be disappointed when you actually do a little bit of research.
Just down and look at the numbers and calculate your returns, and you'll see that if you just do simple math, that it's not what it should be. Or you can call us and we'll help you.
Oh, well, I'll be glad to ask for Chris.
Or Al. Indeed. So I hope this is really informative. It's a really important issue because it's your money. And as Chris pointed out, the difference between 1 and 2 and 3% is enormous.
Huge.
It may seem really small. 1% doesn't seem like much. 2% doesn't seem like much. But the difference over a long period of time is huge.
And don't wait. Don't wait. If you're in your 20s and your 30s and you're listening to this and you're like, oh, I got plenty of time until retirement. It's going to be okay. It doesn't really matter. Don't. Set yourself up right now.
I'm telling you. I'm 70. I'll be 79 in a couple of weeks. If you're in your 60s, don't wait. If you're in your 50s, even if you're in your 70s, don't wait. I mean, we have a long time to be together. I'm 79. I expect to be here in 10 or 15 or 20 or 30 years talking, and we'll be talking about the Baltimore stockbroker in 30 years. Thanks for being with us. We'll be back again to talk about money this coming week. Have a very